This is Trepp Wire Week in Review for week ending October 30th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. Joining me are Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, we had some bits of positive economic news, a rise in home prices, and a jump in durable goods orders for September. But eyes are on the third quarter GDP number tomorrow, which is expected to set a record for quarterly growth. Despite this, markets are down sharply, and consumer confidence has dipped as the virus continues to rise to new levels in Europe. And now, just days until the election, there is concern that declaring a winner may take time. Manus, by some of the macro numbers, it appears that the worst of the recession was in March and April, but clearly we've not seen the other shoe drop.
Yeah, it's been an interesting week, to say the least. You highlighted some of the positive economic data, which is encouraging on the housing front, for sure. We saw some decent manufacturing data, some decent consumer confidence levels that, even with COVID and no stimulus, the numbers have held up fairly well. So, that's the good side of it. On the other side of it, we now know that we probably won't see a stimulus deal perhaps until January, now that Congress has recessed for the election. We do have a lot of election uncertainty and, dare I say, angst, right? I think that people are going a little bit out of their minds from what I can tell, with anxiety, one way or the other. For me, the anxiety has manifested itself with this recurring dream/nightmare that I wake up on Wednesday morning to find out that 17 candidates have already thrown in their hat in the ring for 2024. The first debate is slated for Saturday, and there's already a new campaign out for the most unlikely of candidates 4 years hence, Meghan Markle. I think there's a lot of bizarre election nuttiness that is just rattling people, and that has helped send the market a little bit lower this week.
I'll be glad when it's over, no matter what happens. And at this point, I really feel that, stimulus is dead for the foreseeable future. And the only hope that we have is vaccine. Like the positive surprise of a vaccine, getting approved in late November or mid-December, something like that. I think that really can be a huge upside surprise for the market. But then again, we're all subject to extreme recency bias. So the market's down pretty big this week, but it could very easily be rallying a few days after the election if the results are clear, or, there's some other way of us saying there's not going to be as much uncertainty for as long as we expected. So I don't know. I think it's a gray, dreary week, and that's just adding to our general market malaise.
So let's look at CMBS spreads, Manus.
Yes, we talked about the market selling off. We saw a bad day Monday. We saw kind of a hold steady day Tuesday, and then a big sell-off on Wednesday on the equity markets. When this happens, you normally see a widening of spreads in the CMBS and CMBX markets. That was true this week as well. So to orient people as to where we see pricing levels, currently, we would call the 10-year AAA conduit bond 90 over swaps to 95 over swaps. That's about 5 basis points wider than it was at its best a couple days ago, and it probably gapped out another couple basis points today. Further down the curve, junior AAAs probably swaps plus 125, double A's swaps plus 145, single A's swaps plus 230, triple B swaps plus 375, triple B minuses swaps plus, let's say, 550. I would say for anything below the AAA, we're probably 10 basis points wider week over week. That was before today, and I would say we were probably 5 to 10 basis points wider today after the sell-off, maybe more for weaker credits, weaker shelves. So that's where we are on the fixed rate market. On the floating rate market, which can vary considerably from deal to deal. As a quick educational segment, a lot of the floating rate stuff is non-stabilized, transitional properties where tenants are being turned over, near-term leases are coming due. They tend to be shorter term with some embedded loan extension. So you may see a 2-year maturity, but 2 or 3 12-month extension options for the borrower if they meet certain targets. So that's what we're talking about. It's for the borrower who doesn't want to lock in 10 years at a certain valuation if they think the value is going to go up in the near term because of their execution plan. What we're seeing there in the floating rate market, AAA, let's call it LIBOR plus 150 or SOFR, as the case may be, whatever your index of choice is these days. Junior AAAs, let's call it LIBOR plus 185, double A's LIBOR plus 220, and single A's LIBOR plus 275, right? I would say that that's for a bank shelf with a good track record. If you're talking about smaller issuers with a shorter track record, add probably another 25 basis points to those spreads, maybe 35, 40 down at the triple B minus level.
So those, Manus, that you're talking about CRE CLOs at this point? Or are you talking about
some people call them
floater SASB type stuff?
It's not floater SASB. SASB is a different category. And next time we give spread levels, we should probably quote those too. This would be for multi-borrower. Some people will call them CRE CLOs. Some would call them just large loan floaters.
Yeah.
Multi-borrower, short-term transitional paper.
So those are probably something we should talk about at some point in more depth. But, I see those slightly differently than, your pure conduit. I think, conduit originators originate loans to sell to the CMBS market, and they do that to generate, the arbitrage, essentially to make a profit margin on originating a loan for $100 and selling it for $100.25 type of thing. The CRE CLOs generally, I wouldn't say all the time, most of the time, this is a financing vehicle for lenders in that bridge loan space, right? So I'm just looking at the list, and it's people like Blackstone and Exantis and Annaly and other bridge lenders. And really what they're seeing, they have a balance sheet of a few hundred of these bridge type loans, and either they leverage that up with a warehouse line from a bank, or they tap this CRE CLO market. And I think it really just depends on those spreads that Manus just mentioned. If those spreads are nice and tight, then they go to the CRE CLO market because that means that their cost of financing is driven down and their total returns can increase. But if those spreads kind of blow out, then they'll have to go back to the warehouse guys and hope that their cost of financing has not increased significantly on that side as well.
Let's look at some of the other Tripwire stories, Manus.
Yeah, we have several that I'll run through. One that we're running, I think Thursday morning. This is for all the urban cowboys out there. Johnny Utah's near Rock Center will be closing. It's a basement bar and grill with a mechanical bull right when you walk in there, right near Trepp's offices. It's the only tenant behind a small CMBX 6 loan. It's a $2.6 million loan. So one of the smaller things that you would see in CMBS. Johnny Utah's lease ends in 2021, and that is either already vacated or will be vacated shortly. And, Martha, when you go looking to go mechanical bull riding, you're going to have to find another location.
Manus, didn't you, for a short period of time, hold the record for longest to hold on to the mechanical bull in the 53 to 55 and a half age division?
Yeah, there's probably a ribbon somewhere, in a shoebox somewhere in my basement. Other stories we have: the value of the Port Charlotte Town Center in Port Charlotte, Florida, was reduced from 80 million to 28 million. That's a mall with about 500,000 square feet. We've written several stories about things like this recently, and we'll talk a little bit more about that later in the episode. We'll talk about the Winter Haven City Center. Winter Haven is kind of central Florida. It used to be the home of the Red Sox and later the Indians for spring training baseball. There's a $12 million loan that's part of CMBX 7. Macy's and Belk's are the top two tenants, 73% of the space. They are expected to vacate next year. So they'll leave a big hole in that property. So those are some of the stories we've covered this week.
Breaking these down by property type, we've talked about multifamily, which for now has dodged the severest blow of the recession. I think the delinquency rate that we talked about, the preliminary numbers were 3.14%. And I think we're going to publish the final delinquency report early next week. So you can look for that. But we're seeing a spike in things like rent discounts, and a study of unemployed workers released by the Philly Fed says that outstanding debt could reach $7.2 billion just by year end. So what's going on there?
Well, that's not even counting credit card debt and auto loans and everything else that the average consumer may have that's renting. That $7.2 billion is their estimate of what the total kind of back rent owed is, right? So just like we've been talking about the shoe that we've been waiting to drop in terms of forbearances and everything else that have been going on during this pandemic, which we're starting to actually see that shoe slowly defenestrate itself. This idea of everyone's been kind of given forbearance on their rent, right? Rent relief or rent, payment plans, things like that. Eventually, those things need to be paid back. It's not a forgiveness, right? So if you're paying, $900 a month in rent somewhere in Middle America, and your landlord says, "We'll give you 3 months off," you still owe $2,700 at the end of that 3 months, right? And you probably, if you're that kind of blue collar, maybe service worker or something like that, a lot of those jobs have still not come back. So I don't know how the landlords who are probably exercising some sort of forbearance with Fannie Mae, how are they expected to pay back what they haven't paid on their mortgage, right? So there's just a bunch of stories this week on things like that. So eviction moratoria are, a lot of them are coming to an end, by the end of the year or even sooner. So at that point, the question is, do the landlords bite the bullet and just start trying to kick people out? And if they make that decision, does it make any sense are there enough renters on the other side that are ready, willing, and able to move during a pandemic, during this epic level of uncertainty? And are they creditworthy enough to move into your space? So I don't know. I think I kind of have this picture in my head of the hotel line graph of just say performance or occupancy or NOI or anything else. And it's spiky, right? It's way, way down to almost zero. And then I think, post-vaccine and post-election and other things, as people start to travel again, it's already happening. People are traveling again. You're going to see a real strong uptick. That's going to be V-shaped. I feel like, office, multifamily, and some of these other property types that had been so far immune, it's just a slow burn downwards, and we saw that with, you mentioned it, the rental prices as well. I think it was, Street Easy that said that the median asking rent in Manhattan now is $2,900, $2,990 in the third quarter. That's the first time it's been below 3,000 in 9 years. So, Manus might be moving back into the city, into that apartment where the rat crawled over his chest while he was sleeping.
For the record, that would be my back. And yes, the mental scars have never healed. The interesting thing when we tie this back to the election is, I really don't know how this goes. There's 6 possible combinations of the presidency, the House, and the Senate, right? When you think about each one being red or blue, and certain permutations have higher likelihood than others. But if we do see the blue wave, that some people are calling for. I could see 2021 being, forgiveness palooza, right? There's already been calls for forgiving student loan debt. I could see anything running through Fannie and Freddie, delinquent loan payments being forgiven and so forth. I just think that there's going to be a lot of accommodating action being taken if we do see that blue wave. Less so if we see a split government, but we'll all know by Tuesday or the following Tuesday or the Tuesday after that, depending on how fast these ballots can be counted.
Turning to hotels, we've talked about this, and there was a recent story that talked about investors looking for opportunity to move on distressed assets, but the timing obviously needs to be right. So what do we think is going to happen there?
I think we see a really heavy wave of selling of either notes or properties by special servicers over the next 3 or 4 months. That won't come as a surprise to people that have been listening to the podcast for a long period of time. I think that this downturn will be extraordinarily compressed. When we put out our research last week, we did put out a list of 100 loans, $4 billion in outstanding balance, heavily tilted towards retail and hotel, where the borrowers had signaled a willingness to throw back the keys. It's interesting. We put out a blog on that. If I'm not mistaken, it was our 3rd or 4th most read blog of all time for that, because people wanted to get their arms around where the properties were and how big they were and what the makeup was. It would not be beyond
a month from now or 2 months from now, that list, there's going to be another list of another couple hundred, don't you think?
Well, it's like the bathtub, coming in and out, right? Draining and going in at the same time. Some will be cleared out and will become REO. They won't even be notes anymore. They'll already be on the runway ready to take off.
Mm-hmm.
And or some will have been liquidated, but then you'll see a whole nother $1 billion bucket coming in.
Yeah.
What we did see this week, or I should say this month, with the remittance data is we saw a couple of big loans where the forbearance had ended. The loan was current for a short period of time, a month or two, and now it's back to 30 or 60 days delinquent because the forbearance is over. Reserves can no longer be tapped. A second forbearance apparently has not been granted, and you may see more of this. So the idea that this $4 billion could turn into $6 billion, certainly not out of the question over the next 60 days.
Yeah. On the other side of that coin, of all those sales that you're talking about, note sales, REO sales of property and things like that, there was a story in skift.com. I hadn't really heard about that article, that website, but Martha found this good article about Starwood, and they're scheduled to close at the end of the month on $6 billion of a targeted $7.5 billion fund, which is going to be used or go toward buying distressed assets in the hotel space. I liked the quote from Barry Sternlicht where he said, "I can't emphasize enough how important it is when you go in, especially if we have a second wave, that you're going to have no cash flows or you're going to have negative cash flows the first year or so. My base case is we're going to have a vaccine. Travel resumes third quarter of 2021 to some level of normalcy. The assets will recover at different paces, and you have to model it out." So we've been talking about that for a while about, how do you come up with a value for any of these properties? And I think in the distressed space, it's really you can do all the underwriting you want, but in the end, you're hoping that you can just come up with a valuation, then haircut it come up with a stressed valuation and then haircut it and buy it at that value, so that you have a lot of leeway in between, so that even if you do have very, very low occupancy for the first year or two, your basis is low enough that your returns will be met. So we've seen this firsthand at Trepp for the last 9 months in terms of acquisitions folks and hotel investors and asset managers looking to capitalize on this, because whereas retail might not come out of this unscathed, and the office, property type might be changed forever, I think people are still going to travel and want to stay at, and have to stay at hotels in the future, right? So the recovery there will happen. It's just a matter of how long it will take.
There'll be a lot of pent up demand when that vaccine comes.
Oh yeah.
Particularly for leisure travel. No doubt about that. Whether it comes back, hard or soft for business travel remains to be seen. I think I'm probably a little bit more bearish on the business travel than I would be on pent up leisure travel demand. But if you're, if you're going into this, your worst case scenario, you got to be praying to the lodging gods that you're not using this as a high end paintball destination in 2 years.
High-end
Or a
paintball.
COVID
They don't go
ward.
together, actually.
Plenty of nooks and crannies to hide and pick off the enemy.
Real life
Shoot people?
Fortnite.
Yeah, exactly.
That actually might work if you make it a real life Fortnite. You'll have 1,000 12-year-olds running around.
I'd sign up for that.
Yeah, make sure your insurance is all paid up.
We normally have our deals of the week later in our podcast, but we are going to push them up. And lest you think I'm repeating myself, we have a deal of the week and a deal of the week. Week spelled EE and EA. And for those of you that are curious, those are homophones.
Look it
I
up.
would have guessed that they were homonyms.
No,
My
homophone.
education at Nassauqueg Elementary School in Stony Brook on Long Island must have been lacking because I would have bet my life that those were homonyms. Anyway,
Yeah.
the deal of the week, the positive one, WEEK, Taubman Centers sold the Stamford Town Center to Safavea subsidiary Yarragay Realty. The story was first reported by commercial property executive, writer Gary Isaacson. The piece called the asset challenged, but it does show that there's a bid still for retail properties. So we think of this as a positive. Stamford has had its challenges in the office segment over time. It's had challenges in the hotels segment. This is a 9-floor retail property with 100 tenants in Stamford, Connecticut. Covers about 800,000 square feet. Newmark's Christian Banger or Bangert, I'm sorry if I've mispronounced it, repped Yarragay. And Eastil's Chris Hoffman and Steve Levaditis repped Taubman. Yarragay is intending to operate the property as a mall. There was some talk about a would-be buyer converting that to something else. So, we like to underscore the positives of the market. And while we don't have a sale price for this asset, the fact that somebody is coming in and buying a mall property is signs that there is a bid out there. Also from commercial property executive, this one from Sergia Anesian, Partners Capital acquired an Austin, Texas retail property that backs a $6.7 million CMBS loan. We'll be writing about this asset next week in Trepp Wire. It's a 26,000 square foot property that has a mattress firm, a jeweler, a dentist, and a Schlotsky's Deli as tenants. So again, you're seeing a situation where some of the tenants may not be operating, like the dentist at this point, but yet there's still a bid for this. Partners Capital, part of NAA, was the buyer. They were repped by Drew Fuller of JLL. Veritex Bank provided the financing. And as usual, sincere apologies to anyone and everybody whose name I mispronounced, which I seem to do regularly.
I like that last one. That sounds like the type of place that I would like. You get your roast beef sandwich, you get your cavity filled, you take a nap, and then you go home with a new bracelet.
There you go. It's something for everyone. The deal of the week, WEAK, the $62.7 million mortgage on the Burnsville Center property in Burnsville, Minnesota, was up for sale on 10X. It had an opening bid of $7 million. We talked about this being a benchmark for how much commercial real estate values in the mall space had fallen. For those who might recall, this was a CBL asset. CBL has been on the ropes. The REIT has been on the ropes for several months. They have been giving back properties through deed in lieu for a period of time. Burnsville was one for which they had flagged this as the likely outcome. The auction was done via 10X, and we'll talk a little bit more about that shortly. I don't want to give away the exact bid that was the top bid out of respect for 10X's proprietary data, but let me just say that it was under $20 million. So you're talking about 2/3 of the value or more written off on this particular asset. At the bid that was the top bid, which wasn't 20 million, it was a different number than that. The website was said to have met the reserve price. Now, a quick plug for 10X. People have asked us before, how do you determine what new values are for properties in this kind of market? Real Clear Markets, and which is CW Capital's auction place, and 10X do auctions all the time. This is a bona fide way to get a sense of what value is. If you're willing to sit there and watch the bids come in, it's a useful and more accurate level of valuation than you would get out of appraised values that we talked about recently in another podcast. So it's a good site for seeing what's happened in the market. The appraised value on this property was 137 million in 2010, meaning that this bid was more than 80% less than the value in 2010. This loan is part of GSMS 2010 C1. If you're talking about this kind of loss hitting this deal, you are likely talking about losses running through the E, F, and G classes and touching part of the D class, which was originally your triple B minus class when it was issued in 2010. So in 2010, we were thinking that loans and deals were really conservatively underwritten. In this case, we're looking at losses that could hit the triple B minus class, and that's newsworthy. And it just goes to show how far the mall space has moved in the last 10 years.
So it'll break through the old B piece.
Yep.
Right.
That's right.
Okay, so finishing out retail, we saw a story in the Wall Street Journal that talked about landlords going after the rents a little bit more aggressively or giving it up.
It's part of that defenestration of the shoe that we talked about before, right? And we saw a article in Commercial Mortgage Alert last week, and Lisa Pendergast of CREFC was in it, and a few other people in the industry quoted about how servicers are actually starting to put the pedal to the metal in terms of seeking remedies for borrowers that are not paying, right? So same thing goes for when that happens, the landlords then have to seek remedies for the tenants that are not paying. And that is this entire cycle of capitalism that we talk about, right? People need to pay their liabilities so that the people they're borrowing from can pay their liabilities, and so on and so on and so on. And I think that kind of pause that happened could not last forever. And forgiveness palooza, I think if that does happen, we'll have some issues as well in terms of who holds the bag in the end. So
we're going to see landlords walking through malls dressed up in Halloween costumes, carrying those orange pumpkins, pretending to be trick-or-treaters and serving their tenants with summonses, to collect their rent. Is that what we've become?
Or maybe they don't have to dress up at all, and then the people in the mall will just assume that they're dressed up as a process server for Halloween, right? Oh, there's a guy dressed up as a process server. Got a good mustache, right? Good sweater vest.
Looking lastly at office, we've seen some more news that the numbers of workers going back to the office is going to be reduced compared to what they originally thought. And one of the latest industry sectors to reduce their footprint is legal. So law firms are now, according to Cushman Wakefield, not going back.
Nobody's ever going back to the office. That's the way it feels to me right now. That's not the truth, but that's just how it feels. And I think all of these surveys that you see, Martha, you put together some of these numbers from some of these surveys. I think this was from NREI, National Real Estate Investor. Tech employers see 49% of workers coming back in July, compared with 74% that they were saying a few months ago. Finance and insurance companies are saying 52%, et cetera, right? So I don't care what type of company you are, unless you have to be in the office, it seems like everybody's looking left and right and saying, we're not going back until you go back. No, we're not going back till you go back. Right?
I wish I had
first.
the source for this. I don't have the source, but I wish I did. There was a poll being done that they asked CEOs when their next lease was coming due, would they look to shrink space, maintain space, grow space? And if I'm not mistaken, I believe that 76% said either shrink space materially or shrink space a little.
I think that was
And-
the partnership for New York.
That's a staggering number. And if you're an office owner, you got to be praying to the office gods that you're not using that office as a high-end paintball destination in a couple of years.
Or a Fortnite battleground. Why is it always so violent? Right?
Part of the game. It's part of the game. All right. Now on to shout outs. We have a couple of good ones. Joe D had not only did he send us an email, but he sent us a very nice picture on the topic of the Tampa Bay Rays, where you called them the Devil Rays, and you took that back knowing full well that they had changed their name back in 2007 when they were rebranding.
Still, and then Joe sent us a picture of the hats they wore the other night that had a picture of Devil Rays on them. So, I mean, unless the Bronx Zoo calls me and tells me that they stopped calling those things Devil Rays, I'm going to still call these guys the Devil Rays.
And they still lost to the Dodgers.
Before we go into more shout outs, I have to say, well, first of all, Joe D goes by the Yankee Clipper, and he's one of the biggest baseball fans of all time. So he would know, he's our authority on baseball. But I have to say that these games went on so long during this World Series. It was awful. I got to say, where is the 2-hour baseball game? Now you go in, you're 2 hours in, and you're in the fourth inning, right? When the game's over,
pitcher.
You're rolling into the Today Show, right? It's crazy. It's like watching one of those 3-day cricket matches between Sri Lanka and Pakistan, right? It's just not the way it should be.
Cricket, so
it shouldn't. It's not the way it should be. And
it has to self-correct because I heard the ratings were abysmal.
They have to be.
It's probably due to the fact that it's the LA Dodgers and nobody in LA watches their own sports teams, and the Tampa Bay Rays.
I know the Rays have worse.
There's not a lot. There's not a lot of. That's not a large market.
Yeah.
But
when these games were over, Fox was the only network not showing infomercials. Everybody else had the ShamWow, the no stick frying pan.
Here we go, back to the no stick frying pan.
That thing that holds your phone in the coffee holder.
Yes,
my WeatherTech.
Yes.
Hey,
no free ads.
No free ads. I already gave one to 10X.
And our other shout out.
Look at that. Coach just went right at you.
Our other shout out goes to Mark E, who actually sent us a very thoughtful email, and he was responding to some commentary about our trading alert that highlighted the valuation hit to the Houston office. So, Manus.
Yes, I'm going to give a few more shout outs because I know that the Mark question will take me a few minutes.
Of course.
I wanted to give a shout out to everybody who has both, taken the time to listen to a very refined woman and two jerks. Thank you so much for listening.
I hope you were talking about me.
So yeah, it's great. And a couple of other things. I mean to do this much more often than I do, and I want to tie it back to the uptick in COVID cases that we saw this month in so many different areas. Just a shout out to everybody else who's out there, client facing, nurses, doctors, bus drivers, school bus drivers, food service workers, and anybody who's listening who has family that's doing this. You're doing really God's work to keep this economy going and keeping us fed and our kids engaged. And even though it has nothing to do with commercial real estate, I do like to throw that out at least once a month to our listeners out there. And back to Mark E's question, what he was asking about is we talked about one of the Westlake properties in Houston, which had a big cut in valuation. That valuation basically means that there's to use a term or to coin a phrase, dead tranche walking, meaning that there's losses building up.
Loss waiting to happen.
Loss waiting to happen, which means that at some point, starting with the first loss bond and moving upwards, losses will erase debt holdings from the bottom up. And that's kind of what we talked about a minute ago with regard to Burnsville. So the way it works is, well, there's two ways it works. In the quote unquote old days, pre-great financial crisis, the special servicer was often the B-piece holder. So the B-piece holder had income coming in as special servicer, and they also had P&I coming in if a bond lasted long enough. And they would usually buy things from the double B plus through the unrated. If appraisal reductions got big enough that all of their bonds were effectively dead bonds walking, then in essence, they're expecting to get no money back in P&I from their holdings, yet they're still making special servicer income. And there were concerns during the bonds that were issued pre-great financial crisis that this created a conflict of interest, that special servicers were incentivized to keep loans outstanding, not appraise them lower and so forth, because their fees would keep coming in, even though they would not ultimately get any P&I income back on those things. And if the fees kept adding up and adding up, effectively you're taking money away from the principal to other bondholders that you would otherwise recover. And to be sure, that was certainly perception that was out there, but it would certainly lend itself to discussions about misalignment of interests. So post-great financial crisis, what we've seen more of is the buyer of the B pieces hires a special servicer, and that perception of having a conflict of interest has been diminished. It is less of a concern now than it was during the great financial crisis. So I hope that answers your question, but if not, ping us again and we'll give another crack at it. And if you have opinions on this, we'd love to hear them. So
yeah, well, I think the moral of the story is that the structures have to be put in place that align the financial incentives of all the different players with the best interest of the ultimate investor, which is the bondholder. And I think that risk retention and other things, the operating advisor and those types of, and different structures, like you're saying, the BP Sky not also owning the special servicer, those things have done a better job of aligning incentives.
Yeah, I mean, a very simple example would be right now, if a guy were to come to you, and we talk about this in one of our Trepp Wire stories, either it's forthcoming or we talked about it this week, a borrower asked for a yield maintenance charge to be lowered in return for paying off the loan. And when you do something like that, that may be beneficial to the first loss guy. It could be a loss waiting to happen down the road. In this case, I believe it was single tenant retail where the tenant was like a yoga shop, a gym. And, but if you do something like that, if you decide to make that accommodation and you lower that yield maintenance charge, effectively you're taking money out of the pockets of IO holders and first pay guys. So it is complex. And to the extent it sounded like I was trying to throw anybody under the bus, special servicer wise, certainly not. I know that there are standards and practices and walls set up between organizations. So certainly not looking to poke anybody in the eye.
But there's a clear element of, there's no objective correct move every time, right? Because in that case, you have to be able to predict the future in order to say whether that's the right move or not, right? So you have to make your best possible guess on what the future holds and say, either I think that I'm going to recover the highest net present value to the bondholders by executing a foreclosure or, going REO and selling this property, or modifying and extending, or, doing a discounted payoff, right? So there's so many different tentacles to this that only in hindsight do you know if it was good or bad, right? And that's when usually people start judging things in hindsight.
And I'll take this back to Joe D, the Yankee Clipper, right? It's like The manager who has to change the relief pitcher. Last night, that Devil Rays manager,
The Rays.
sorry, the Rays manager took that pitcher out who was throwing a 2-hitter, right? And the next thing you know, a 1-0 leads a 3-1 loss, right? So, you kind of look at it the same way, these special servicers. You try to do the best you can, and you hope you don't blow it.
And in the spirit of Halloween, which is this Saturday, in case you're keeping track, we typically post a blog about CRE properties that have some spooky lore and legend attached to them. Joe, do you have any favorite haunts, so to speak?
Well, I actually live about a mile north of Sleepy Hollow.
Ooh.
So when I drive down Route 9, I see all of the trick-or-treaters, or I should say the Halloween enthusiasts, walking through that giant Sleepy Hollow cemetery. So they have all sorts of kind of tours and everything like that. I have to give a shout out, first of all, to Haley, who put together the blog this year, but to our old friend, Sarah,
Trepp
who
alum.
initially came up with this concept, which was, it's like a classic, radio show or TV show concept where, hey, it's a holiday, let's do something light, and we would do, stuff. Here's all the CMBS properties along the Thanksgiving parade route, or here's all the CMBS properties in Christmas movies, and this is our version, our Halloween version of that. So go take a look. It's kind of funny. For me, going on the other side of the coin here, I hate Halloween. So I hate it. I mean, it's really just, I'm not a big candy guy. It's kind of sacrilegious to say that. I always never really knew what I wanted to dress up as, except in third grade where I was going to be Elvis every time. But otherwise, Halloween's just not for me. So I'm ready to move on. I'm ready for Thanksgiving. I'm ready for turkey.
Weren't you scarred by, one time being the back end of the horse in that 2-man horse?
That's what it is.
Horse costume. You never really got over that. So this is one last shout out before we cut the cord here today. That's right. A shout out to everybody waiting patiently to take part in our greatest American privilege. Amen.
Amen.
Go vote.
Amen, brother.
Amen. Go vote. And if there was ever a year we needed Halloween, it's this year. With that, we'll close. Thanks to our producer, Keegan St. Ange. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment or some thoughts, send us an email to podcast@trepp.com. For more info, visit trepp.com and subscribe to the Trepp Wire podcast with your favorite provider. Thank you for listening. Go vote and stay well.
All right.